All right.
The broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to this webinar about $CAD and its key characteristics. The webinar is brought to you by OctaFX, an award-winning forex broker that has one of the lowest spreads in the industry. So, a bit of housekeeping before we begin. Some disclaimers. A risk disclaimer. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. And a hypothetical trading disclaimer. All the information provided in this webinar is provided as general market commentary and does not constitute investment advice. A few words about myself. My name is Yohay Elam, a forex analyst, used to be a retail trader and a computer programmer, and I founded Forex Crunch back in 2008, where I focus on, and also here, on fundamental analysis. On the agenda today about $CAD, we're going to talk about oil, which of course is a key driver for the Canadian dollar, but not only about oil, we'll touch other topics as well. We'll talk about the loonies mood swings, okay? It has these different periods, we'll explain everything. It has slow reactions and opportunities to economic indicators. That's our third topic. Our fourth is times to stay away from trading this currency pair, and we'll discuss its technical behavior, which is a bit mixed, and we'll explain everything. So let's begin. Oil. Canada exports oil from tar sands from Alberta and from other places, and the Canadian dollar is related to crude, but it's not only that. This oil from the tar sands is expensive to extract. It means that when oil prices are down, the Canadian economy feels it more than in other places, because at some point, at some price, it doesn't break even. It's just too expensive to extract this oil. It's a key export, oil, of course, but and it means a key reaction to oil prices, but it's not the only thing. The best reaction, if you're looking at the weekly release on Wednesdays of oil inventories, the best reaction on the charts is of $CAD. And of course the Canadian dollar is sensitive to everything related to oil, especially what we hear from OPEC members. If they want to cut production more or not, it has an impact on oil prices, and you see it immediately also in $CAD. Another oil related thing, there is a planned pipeline between Canada and the Gulf Coast passing through the United States, of course, called Keystone XL, Keystone Extra Large. The Obama administration denied it. Now it's under discussions by the Trump administration. It's moving slowly, just another thing to watch out for. But it's not only oil. It was only oil back in 2014 when the big drop came. November 2014, oil prices collapsed, and since then they're wobbling in a much lower range. They used to be $100. Now in the past 2-3 years they're around between well, the bottom was 26 and the peak was 55, but in general the $40 handle is quite common. Canada's economy has already absorbed the pain. Okay, we've already seen the rate cuts, we've seen economic slowdown, the drop in the currency. The economy and the currency have already absorbed it. And Canada, what I mentioned a few times, is not only about oil. The economy mostly depends on US demand. Now, these changes in US demand don't move, the changes are not that big to move the currency that much, but it has a bigger role in the economy. So you see more reactions to oil, but most of the Canadian economy depends more on demand from the United States. And of course, it's not only the United States, it's the NAFTA deal, the EU deal that was recently signed called CETA, Canadian-European Trade Agreement, and relations with Mexico and other topics as well. And of course, it's talking about trade. We're talking about the new president in the United States, already 6 months in office, Donald Trump, and he wants to change trade deals. So at some point he wanted to leave NAFTA altogether, which would have been a big blow to Canada. Anyway, anything related to trade, softwood, lumber, beef, everything has an impact. What the United States does has an impact on Canada. Housing. Housing, there were fears of a housing bubble since 2012. Okay, maybe now it might be happening with the big crash in prices in Toronto in the past 2 months. Last month I think it was even double digits. So something to watch out for. It could have an impact on the Canadian economy for years. So far we're not seeing it, but it's something, it's sort of the bigger picture. When you're trading the Canadian dollar, you should always have one eye or half an eye or an ear open to news about the housing sector. And if this housing issue is not contained, it can certainly move the currency. So again, something to watch out for. Okay, our second topic is mood swings. The loonie often reacts or moves in one direction for weeks. Okay, when we're talking about a positive mood swing, it moves higher on positive data, even if the data is a small beat. The Canadian dollar takes advantage of every piece of good data and ignores weak data. That's when we talked about trading the news, our first fundamental webinar. We talked about these kind of about strength and weakness of currencies. Canadian dollar has it more than any other pair. Okay, and we're talking about negative mood swing. It ignores good data and crashes on disappointing numbers. So any small disappointment can just crash the Canadian dollar. Okay, more about mood swings. You can recognize them in the reaction to oil prices, to changes in oil prices, to the reaction to inventories. When you see oil prices collapsing and the Canadian dollar doesn't move that much, that means it's relatively strong. The Canadian dollar is strong, and it has a positive mood swing. The other way around, of course. You can see it especially again in the inventories release every Wednesday at 2:30 GMT. If the Canadian dollar jumps on rising oil or ignores falling oil, it's in a good mood, and if it crashes with sliding oil prices or ignores rising oil, it is in a bad mood. And these mood swings, which I call them, or strength and weakness, if to use a more calmer term, these last for longer than in other currencies. Okay, now let's talk about reactions to other indicators, and these can be slow, and this has advantages. The Canadian dollar reacts slowly to indicators, and this provides an opportunity to jump in, because if you see jobs report coming out better than expected, you see the Canadian dollar rising, but it doesn't rise instantly and then corrects or reaches its peak, or you don't know what happens. It usually reacts, in this case, positively, and then continues advancing relatively slowly. Okay, so we have an even leveled playing field with the big boys. So sometimes, of course, trading is done a lot by algorithms or with the professional traders, the big boys. In this case, with the Canadian dollar, the smallest of the retail traders has enough time to read the news, understand it, and jump in. And well, the best opportunity is with the jobs report, but it's not only the jobs report. It's released on Friday, first or second Friday of the month. Canada has quite a few market moving indicators. So another special thing is in Canada is that GDP is released once per month. Okay, we have monthly GDP. In most countries, or all countries that I know of, it's released only once per quarter. In addition, retail sales, inflation, manufacturing sales, which is a figure that doesn't appear in other countries or doesn't have such an impact in other countries, building permits, all these indicators have an impact on the Canadian dollar. The reaction to the Bank of Canada is also relatively slow, but a bit more messy. So when we have rate decisions, there are 8 rate decisions every year, we also see a slow reaction, but it's a bit more choppy than the more straightforward reaction we usually have to the jobs report, for example. Of course, there's always a bigger opportunity on a bigger surprise. I'm not talking only about a bigger jump to the upside or a bigger crash to the downside if it's a bigger surprise or disappointment, but also we're talking about long moves that last for longer, that have a bigger, provide more opportunities to jump in. Okay, now we talked about the positive things. Let's talk also about some negative things about the Canadian dollar. Times to stay away. Easiest one, we're talking about dollar CAD when we have simultaneous releases in the US and in Canada. So figures can just go other direction. In the US, the jobs report is released on the first Friday of the month. In Canada, it's sometimes the first Friday, sometimes the second Friday. When they're released at the same time, of course, we can have a strong reaction, but trade with care. This can be a very messy time. The US jobs report is the biggest mover of Forex in general. Okay. Trade balance figures, they're always released exactly at the same time in Canada and in the US. So it can also be messy, and yeah, so trade is worth trading only after a long pause. So once you read the US data, the Canadian data, decided, okay, we have an opportunity here. Let's say Canadian data disappoints and US data, trade balance data is better than expected. Okay, we have clear direction. Let's move on this. But sometimes both figures can disappoint, or both figures can come out better than expected, and then there's no real opportunity over there. Okay, other times to stay away. When you see a change in the reaction function, when the Canadian dollar is swinging from one mood to another, when it turns from a strong to a weak currency, or the other way around. When there's higher uncertainty, that means that there is an unclear reaction. When you have a strong Canadian dollar that is reacting positively to data, or you have, on the other hand, a weak Canadian dollar reacting negatively to data, you know more or less what the reaction will be. I mean, you have a better sense. And when it's changing, when there's higher uncertainty, the reaction is a bit less clear. In general, if you're trading the Canadian dollar, dollar CAD, the moves are relatively shallow in the European session, in the European morning. When the US and Canada join in the European afternoon, American, Canadian morning, then we have better volatility, better movements. Okay. Technical behavior, our last topic for now. I know many of you are technical traders, so let's talk about that. Often the Canadian dollar, you can anticipate its movements, understand what's going on when it is in range, than when it's trending. So for instance, now we have dollar CAD trending to the downside, a stronger Canadian dollar. So it doesn't always respect the technical levels. An initial peak can turn into a double top. That we've seen that several times in the past. So once we are in range, it's a bit more predictable and relatively easier to define ranges. So again, a Canadian dollar is better in ranges than in when it's trending. When it is trending, the slow movement means an unclear end to the trend. You don't know when it's going to stabilize. When you have one jump and then trading in range, that is a better situation for the Canadian dollar. More about technical behavior. Well, like with its mood swings, technical behavior has better and worse times. So it doesn't consistently behave badly or consistently behave in a predictable manner, technically speaking. Generally needs the mix of volatility. Of course, we need movements in general, but range trading for the best behavior. So again, range trading, and but we need volatility. In the European morning, we don't have much of that. Recently, the past few months, I'm talking about second and third quarter of 2017, the behavior is improving, but again, this is not there's no guarantee that this will continue. Okay, so now let's conclude everything we talked about regarding the Canadian dollar. Sorry. Here we go. So, oil is a major driver. Canadian crude is important. The Canadian dollar is known as a commodity currency, but it's certainly not the only one. Okay, again, watch out housing, which is a developing story, and trade wars with the US and demand in general from the United States of America, the longest border in the world. Watch out for mood swings. The Canadian dollar tends to either be in a positive mood for weeks, that means enjoying stronger data and ignoring weak data, or the opposite side of that is negative mood swing, negative mood, that means it's falling on weak data and ignoring positive data. And these mood swings last for weeks. Slow reactions and opportunities. In many cases, the Canadian dollar moves slowly in reaction to indicators. It moves in the correct direction, okay? Reacts positively to positive data and the other way around. And the reaction is relatively slow, providing an opportunity to jump in. Beware of simultaneous releases in the US and in Canada. It can be quite messy, and also the European morning is not the best time to trade dollar CAD. And the technical behavior is mixed, prefers high volatility but no trends, which is quite different from a few other currency pairs. So we have a few special characteristics, key characteristics of the Canadian dollar, of trading dollar CAD. Okay, so that's it for today. That's our webinar about characteristics of the Canadian dollar. Comments and feedback, as always, are more than welcome. Stay tuned for further educational webinars that are coming up about other currency pairs, other topics as well, technical webinars, and looking forward to see you also in the regular fundamental analysis shows. So that's it for today for the Canadian dollar. See you soon. Safe trading, and bye-bye.